I want to welcome back Andy Schectman. He's the CEO of Miles Franklin and an expert in everything hard assets to help guide us through some of the recent developments in the world and the craziness that's just been going on. So welcome back, Andy.
Good to be here, Elliot. Thanks for having me.
Excellent. No, thanks for coming back. I did want to have you back because with the daily news cycle of crazy events, it's always great to get an expert opinion on things. So wanted to get your take on just a few recent developments, such as this one out of CNBC. Oil may hit $150 and a surge could definitely escalate an inflation scare, says Jefferies Investment Bank.
Yeah, well, I think if people were really paying attention, the inflation scare people should already be scared. In fact, yesterday, Fed Chairman Powell, as always, backtracked off his terminology of transitory. And I remember the first time that came out, I remember thinking, what the heck is transitory anyway? I've been making a mockery of that literally since they started talking about transitory. It's very obvious that when you look at inflation, not as a function of rising prices, like this story will try to have you believe, it's not. That's the symptom of inflation, which is of an increase in the money supply. And when you look at the amount of money that's been created over the past 2 years, it's extraordinary. 50% of every dollar, Elliot, every dollar ever created in the history of the United States, 50% of it, man, was done in the last 20 months. So the fact that they would have the gall to call it transitory is insulting, to say the very least. You can tell what they think about the combined intelligence of the population. It's no wonder that I remember several years ago. I've been doing this since 1989, and I remember they used to publish something called M3, which was the broadest measure of the money supply. It took into account everything. They stopped publishing that, I don't know, 15, 20 years ago, citing it as archaic. No one followed it. It cost too much money. And then they did the same thing with M2, the second broadest measurement of the money supply. So they are making it very difficult, not only through the information that they give to the public to track the money creation and inflation, but their measurements of it, the CPI, which are at 6%, 6.5%, exclude food, energy, and housing, the three most inflated asset classes there are these days. So, look, the bottom line is that I think that is poor reporting by saying, oh, well, will higher inflation or higher oil trigger an inflation scare. I think inflation is here. The higher prices are baked into the cake, but higher prices are just a maybe what they're saying. I'll take back the poor reporting. Maybe what they're basically saying is it will take something like that to wake people up. You would think people looking at their grocery bills, looking at their heating bills, looking at everything that's really, really gone up in price across the board would have woken people up a while ago. But no, the fact that Powell came out yesterday and admitted that we should get rid of the term transitory to describe inflation, and that the inflationary pressures are higher and therefore appropriate to, in his view, to consider wrapping up the taper of our asset purchases. So they're not going to taper. They'll never taper. They can't taper. Even though they say inflation is going higher, they can't. It'll be a token taper at very best. People will start to really realize, Elliot, I think, really realize, and maybe it will be higher oil prices. And they're already higher, but maybe it'll really be higher gas prices or heating prices or whatever it is that wake people up that inflation is here. It's not going away. What might be transitory is hyperinflation. We may see bouts of transitory hyperinflation, like we saw in the lumber market last year, where the price exploded in a transitory fashion. I think you'll see that in other asset classes as we move throughout the system.
Great. And you definitely kind of covered the big highlights of the week, including what Powell said, which was that he's still planning on tapering, and also that inflation is not transitory any longer. So it is interesting the game they're playing, which is let's try to like convince the market that we're going to taper to keep a little deflationary pressure on, and then just remove that. And is that their last weapon at this point, that they can kind of like tease people with the taper?
And they've been doing that forever, just the talking of maybe down the road, perhaps at some point we might. That's all they have to say, and the market is very reactionary. It's also very reactionary when it's goosed to fit that agenda. In other words, if they speak a certain way, and then you have the commercial banks that do their bidding start to goose equity markets or currency markets or metals markets, whatever it may be, in a certain way, then you get traders believing that's what's going to happen, and the whole thing quickly snowballs. But there's your transitory, never lasts very long when the public realizes that, look, what the Fed can and cannot do are they're running out of options. Well, what can they do? They can mess with interest rates, but interest rates are already in real terms negative. So either they go nominally negative, or they go higher. But this is the problem with everything, is that the manipulation of interest rates, to me, is the whole problem. They've skewed the value of everything by manipulating interest rates instead of letting the market set the interest rates as it should. And so you have a massive amount of abnormalities in price. Let me give you an example. And this, if this doesn't freak people out, I don't know what will. And this is not from me. This is the Bank of America. Bank of America just published this. They have something called their Flow Show report. And in it, they said equities have seen a record 893 billion, almost 900 billion in inflows this year, right? That surpasses the 785 billion of inflows over the past 19 years combined. So they put more money into equities, whoever they are, than we have seen in 19 years combined. This is what has happened by the low interest rates, easy money, goosing the markets, providing stimulus. All of these things that they've done has created a massive bubble in equities. And so much so that in order to keep the game going, they're destroying the currency. So they're destroying the currency by printing enough to keep the markets inflated. At what point, when you blow that much air into the system, even if you don't prick a hole in it, if you just stop blowing air into it, it just starts to deflate. Kind of like a pannekuchen. If you ever made one of those, like the egg souffle, and you take it out and pull it out too quick, it just starts to deflate. Well, I think that's what you're going to see here, unless they continue to pump air into the system, pump money into the system. That's why their tapering will never happen, and if so, it'll be token at best. The market will puke, and they'll go right back to where they were. So, look, we're at the very end stages of this Keynesian fiat monetary experiment. And when you have to pump in more money into a market than that it has seen in the 19 years previously combined, if that doesn't scare the hell out of people, I don't know what would. Then they're just not paying attention. It's the old ostrich in the sand, head in the sand type of mentality. And this is the herd mentality. Well, ride it out until it crashes. Once it crashes, everyone tries to make it through the revolving door at once. And a lot of people get crushed along the way.
And that is interesting. You're saying how the majority of money printed in history all happened recently, and the majority of stock inflows in history all happened recently. So there you go.
Yes.
Now you know where the money went, and how even though the market's rising, the denominator, which is the US dollar, is keeping it kind of flat. And I guess people are feeling that.
And at the same time, the Fed has lost most of its tools. So jawboning being one of them. They told us for 5 months it was transitory. Well, we were wrong. Sorry, it's not transitory. It's actually structural. But we've been saying this since day one when they came out with that nonsense, because let's just remember, they want us all to believe that inflation is rising prices. That's not true. That's the symptom of inflation. Inflation is an increase in the money supply. And when you have 50% of every dollar ever printed in the history of the United States done in the last 20 months, bang, there's your inflation. The rising prices are the symptom of inflation and of the problems created by the Federal Reserve.
Absolutely. And I wanted to end on this because it is just so fascinating given the timing. Singapore piles into gold for the first time since 2000, and we all know what happened after 2000 to the gold price.
Yeah, well, it went on an 11-year bull run up through 2011. Look, what you're talking about there, Elliot, is a wave that I've been talking about since 2017. And that wave is of central banks accumulating gold. Now, maybe that has something to do with gold being reclassified as a tier one high liquid asset or a reserve asset. Uh, and the fact that the central banks have been massively buying it ever since, to me, is of no coincidence. But what it started out as, the larger commercial banks, uh, the German Bundesbank, the Bank of Austria, the Bank of Turkey, Poland, Hungary, the Dutch National Bank, etc., Bank of Russia, Bank of China, is now moving into some of these banks on the periphery, like you're saying, Singapore, right? And so they're traditionally a gold friendly zone, so that doesn't surprise me at all. But you're seeing a lot of countries, as an example. I saw that recently Serbia increased its gold holdings, reached all-time highs. They added 30% more. India increased over the last 12 months another 75 tons. And when you see countries like Russia and China leading the way, I also find it interesting that imports through Hong Kong are up 60% this year. That would be not the government of China buying it. That would be the people buying it. The people who, I think they're seeing their economy kind of teetering on knife's edge as every week another property developer defaults on their debt obligations. The people in China look at gold as wealth. The Chinese have been accumulating gold for thousands of years. They're the largest producers and importers in the world. And I think that when you realize that the smart money, the big money, is accumulating gold, and the West keeps on selling it, it's not going to end well. History has proven that he who has the gold makes the rules. And this is why I think you're seeing the central banks accumulate it, because they see a shift in fiat to something that I think ultimately has to be backed by gold in order to be accepted once again as a world reserve currency. So I do believe that was why gold was reclassified. I do believe that's why all the central banks repatriated it. I do believe that's why all the central banks are accumulating it, because it's coming. It will be part of a new system. And you don't do what they say, you do what they do. And when you see central banks massively buying it, their rhetoric betrays, or their actions betray their rhetoric.
So, as CEO of Miles Franklin, where can people go to learn more and potentially buy gold if they want to?
I appreciate that, Elliot. So look, we are building a new website, and it's been a much more challenging undertaking than I would have anticipated. Our website that is up now lacks for quite a bit, in my opinion, but it does not allow for online purchasing. Our new site will have a limited capability with that, but we're old school, and we believe that precious metals should be more analog, even in this digital world. And anyway, so give us a call or send an email. Better yet, send an email to info@milesfranklin.com and mention the early stage investor. And I will make sure that personally that your listeners get the best price in the country on whatever it is they want to buy. All they need to do is mention the early stage investor. As an example, we're running specials right now for the Cyber Week. We have a Royal Canadian Mint 100-ounce bars at $2.65 over the price of silver. We have 2022 Austrian Vienna Philharmonics at $3.60 over the price of silver. And we also have backdate Silver Eagles at $8.50 over, including in sealed mint boxes. Now, I'm a U.S. mint distributor, one of only 27 authorized resellers in the world, and I almost choke on my words when I say $8.50. The U.S. Mint announced yesterday or the day before, maybe 3 days ago, that they're done producing silver for the year as they retool for 2022. It never made sense to me why they need to do it that far in advance, but nonetheless, I think you'll see premiums on Eagles continue to rise. At $8.50 over, I do believe that's the best price in the country, along with the Philharmonics and the Royal Canadian Mint bars. I'm convinced they're the best prices in the country. But on anything your listeners are looking for, all they need to do is mention the early stage investor, send an email to info@milesfranklin. We will reply back with the current inventory, and one of my brokers would be more than happy, or myself, to reach back out and answer any questions personally.
Perfect. Thank you.
Absolutely. Good to be here. Look forward to seeing you next week.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.